A bank lets you deposit $1,000, and then it lends out $9,000. That is not a metaphor. That is not exaggeration. That is not fraud. That is the system. Right now, as you watch this, banks around the world are lending out money that does not exist in the way most people think money exists. And somehow, the entire global economy depends on this illusion holding together. This matters more than ever because every housing boom, every stock market surge, every sudden crash, and every banking crisis traces back to this single mechanism, a simple trick that sounds harmless until it isn't. Let's start with the version everyone thinks they understand. You put money in a bank. The bank keeps it safe. Maybe it lends some of it out. Everyone goes home happy. That story is comforting. It is also wrong, because banks do not lend your money. They create new money. When you deposit $1,000, the bank does not put it in a vault and wait. It records a number on a screen. That number is a liability. It owes you that money. Then the bank turns around and issues a loan. When it does not transfer existing cash. It types new numbers into another account. That loan becomes someone else's deposit. Money appears. No printing press, no gold, no government approval, just accounting. This is not a loophole. It is the core of modern banking. The name for it sounds technical, almost boring. Fractional reserve banking. But the effect is anything but boring. Here is the simple rule. Banks are only required to keep a fraction of deposits as reserves. The rest can be lent out. If the reserve requirement is 10%, a bank can lend out 90% of what it receives. But the magic happens after that. That 90% gets deposited into another bank, which keeps 10% and lends the rest again, and again, and again. $1,000 quietly turns into many thousands more. Not through effort, not through productivity, through multiplication. This is how credit becomes money. And this is where the system starts to feel uncomfortable. Because if money can be created this easily, the obvious question is not how banks do it. It is why it doesn't blow up instantly. To answer that, we need to talk about trust. Modern banking is not built on cash. It is built on the assumption that not everyone will ask for their money at the same time. Your bank does not have your money sitting there. It has promises, assets, loans that will be repaid slowly over years. If too many people demand cash at once, the illusion collapses. That's called a bank run, and it is not a theory. It has happened over and over again. In the early 1900s, bank runs were common. People lined up outside banks, desperate to withdraw cash before it disappeared. Sometimes they succeeded. Sometimes the doors closed. That chaos is why central banks exist. The Federal Reserve was created not just to manage inflation, but to act as a lender of last resort, a backstop, a promise that banks would not collapse simply because fear spread faster than facts. Central banks do not prevent banks from creating money. They make sure the system survives when confidence cracks.
Now here is where the trick gets more subtle. Banks are not limited by reserves in the way most people imagine. They are limited by demand for loans, regulatory capital requirements, and confidence. If people want loans, and banks believe those loans will be repaid, money expands. If fear takes over, lending contracts. The money supply breathes, and this breathing controls the economy. During booms, banks loosen standards. Credit flows easily. Asset prices rise. Everyone feels richer. During downturns, banks pull back. Credit tightens. money effectively disappears, businesses fail, unemployment rises. Same system, opposite outcomes. This is why economic cycles feel violent. They are not smooth adjustments, they are sudden shifts in belief. Now let's address the uncomfortable part. When banks create money through lending, they also create debt. Every dollar created has an obligation attached to it, principal plus interest, but the interest is not created at the same time. This creates a quiet mathematical pressure. The system requires continual expansion to function smoothly. New loans help pay old interest. Growth keeps the machine stable. When growth slows, stress appears. This is why modern economies,
not because politicians like big numbers, because without growth, the debt math becomes unforgiving. Now, contrast this with how most people imagine money is created. They picture governments printing bills. In reality, the majority of money is created by private banks when they issue loans. Governments influence the process. Central banks set rates, they adjust incentives, but the frontline creation happens inside commercial banks. This flips the narrative most people believe. Banks are not intermediaries moving money around, they are manufacturers. And like any manufacturer, they respond to incentives. Low interest rates make lending attractive. High asset prices reduce perceived risk. Regulatory gaps create opportunity. The result is leverage, lots of it. This is where irony enters. The system is praised for efficiency when it expands and blamed for instability when it contracts. Same mechanism, different mood. The housing boom before the 2008 crisis was not driven by reckless homeowners alone. It was driven by banks expanding credit aggressively, convinced risk had been engineered away. When the assumptions failed, the multiplication reversed. Loans defaulted, assets lost value, confidence vanished. Money that had been created through credit disappeared, not slowly, violently. This is why governments stepped in, not to save banks out of kindness, but because the money supply itself was collapsing. Without intervention, the economy would have frozen. Here is the paradox. The same system that fuels prosperity also creates fragility. It rewards optimism and punishes doubt. It works best when everyone believes it will keep working. That is not a criticism, it is a description. Now zoom out. Why do we tolerate this system at all? Because alternatives are worse. A system where banks could only lend what they physically had would be rigid. Credit would be scarce. Growth would be slow. Crises would look different, but still exist. Fractional reserve banking allows economies to scale. It funds businesses before profits exist. It allows homes to be built before savings accumulate. It moves future income into the present. That is powerful and dangerous. So regulators try to balance it. Capital requirements, stress tests, liquidity rules. But regulation always lags innovation. Banks find ways to move risk off balance sheets. Shadow banking grows. Leverage hides. The trick evolves. Now we arrive at the present moment. Interest rates rose sharply after years of cheap credit. That exposed stress. Suddenly, assets purchased under low-rate assumptions lost value. Banks holding long-term bonds saw losses. Depositors became nervous. Confidence wavered. And once again, central banks stepped in, not to stop money creation, but to stabilize belief. Because belief is the real reserve. Not cash, not gold, trust. So when people ask how banks can lend more money than they have, the honest answer is simple. They don't have it. They create it. And the system survives because we all agree implicitly to treat those numbers as real, until we don't. The uncomfortable truth is not that this system is broken. It is that it is working exactly as designed. Expanding when confidence is high, contracting when fear takes over. The real question is not whether banks should have this power. It is whether we truly understand the risks we accept in exchange for growth. Because the trick only works as long as trust holds, and history suggests that trust is never permanent. So the next time you hear that banks lend money they don't have, remember this: that is not the scandal.
The system runs on faith, and faith, once shaken, is very hard to restore.